Welcome back to the CFO's office. We have spent a lot of time talking about how to start, how to grow, and how to protect you, Inc. We have built a ship, loaded it with capital, and even discussed using the dangerous engine of leverage. But today, we have to do the hardest job in the corporate world. Imagine you are the CEO of a conglomerate like Samsung or General Electric. You have 10 different business divisions. 9 of them are making money, but one division is a disaster. It is bleeding cash. The managers are incompetent. The product is defective. Every month you have to take profits from your good divisions just to cover the losses of this bad one. What do? Do you hope it gets better by magic? Do you pour more money into it, praying for a miracle? No, you shut it down. You fire the managers. You liquidate the assets. You cut the cancer out to save the patient. In the world of investing, we call this a stop loss. Today, we are going to discuss stop loss, cutting off non-performing divisions. This is the most emotionally difficult skill to master. Buying is easy. Buying is full of hope. Selling at a profit is fun. It validates your ego, but selling at a loss, that is painful. It feels like admitting you are stupid. It feels like failure. But the CFO of you Inc. does not have an ego. The CFO looks at a losing stock and sees only one thing: opportunity cost. Let's look at the psychology of why we hold on to losing stocks. When a stock drops 20%, instead of selling, we say, "I'll just wait until it gets back to my break-even price." This is the most dangerous sentence in investing. The market does not care about your break-even price. The market does not know you own the stock. While you are waiting for that dead stock to recover, you are missing out on other opportunities. Your capital is trapped in a zombie division. It is not dead, but it is not alive. It is just consuming your mental energy and your capital. Think of your portfolio as a garden. To have a beautiful garden, you must water the flowers and cut the weeds. But most amateur investors do the exact opposite. They cut the flowers, they sell their winners too early to lock in a small profit. And they water the weeds, they hold on to their losers, hoping they will grow. If you do this long enough, your garden will be nothing but weeds. So, how do we implement a cold, professional stop-loss strategy? We use 3 types of stops. The first is the hard stop. This is a mathematical rule. You decide, before you buy, exactly how much you are willing to lose. If this stock falls 10% below my purchase price, I am out. No questions, no hesitation. This protects you from the catastrophic 50% loss we discussed earlier. It keeps your losses small. As the famous trader George Soros said, "It's not whether you're right or wrong that's important, but how much money you make when you re-right and how much you lose when you re-wrong." The second is the thesis stop. Every time you buy a stock, you should write down why you bought it. I am buying company X because they have a new product launching next month. If the product launches and it fails, your thesis is broken. The reason for owning the stock is gone. You must sell immediately. It doesn't matter if the price is up or down. If the business case is dead, the investment is dead. Do not become a bag holder hoping for a turnaround that isn't coming. The third is the time stop. This is often overlooked. Money has a cost over time. If you buy a stock and it does nothing for 6 months, it doesn't go up. It doesn't go down. It just sits. There you should consider firing it. Why? Because that money could be working somewhere else. You Inc. requires employees, your dollars, to work hard. If an employee is sleeping at his desk for 6 months, you fire him. Treat your capital the same way. Now, let's talk about the aftermath. You sell the stock. You realize a loss. You see the red number on your screen. It hurts. You feel regret. But the CFO frames this differently. The CFO does not call it a loss. The CFO calls it tuition. You paid the market a fee to learn a lesson. Maybe you learned not to chase hype. Maybe you learned to check the balance sheet. As long as you learned something, the money was not wasted. It was an investment in your own education. Also, remember the tax benefit. In many jurisdictions, realized losses can be used to offset gains, lowering your tax bill. So, even if failure, there is a small victory for the clever CFO. The most successful investors in the world are not the ones who never lose. They are the ones who lose small and win big. They treat a stop loss not as a failure, but as an insurance policy. When you sell a loser, you are not giving up. You are freeing up your capital. You are taking your soldiers out of a losing battle so they can fight and win in a different war. Your assignment today is to open your portfolio and look for the weeds. Look for the stocks you are holding just because you don't want to admit you are wrong. Look for the zombie divisions. Be the ruthless CEO. Shut them down. Take the cash. Clear your mind. Once you have cleared out the dead wood, you will have a pile of cash ready to deploy. And hopefully, you have some winners left in your portfolio that are growing beautifully. This leads us to the next great dilemma. You have a winner. It is up 50%. It is up 100%. Do you sell it to enjoy the profit? Or do you let it ride? When is enough enough? In the next episode, we will discuss the happy problem. We will talk about criteria for profit taking, dividends or reinvestment. We will learn when to harvest the crop and when to let the tree grow to the sky. Cut your losses. Protect your capital. I'll see you in the next video.